Sorbh Gupta of Quantum AMC is also here with us. Sorbh, there's a lot of action happening in consumer stocks. Ruchi Soya and then, Wilmer IPO also did well after it got listed. Ruchi Soya, FPO, there was follow-up buying and subsequent announcements after that. Even ITC's consumer businesses are getting a lot of traction, at least if you look at it in isolation. But at the same time, there are other companies which are facing volume headwinds, margin issues. What are your thoughts on not any particular stock, but this space overall?
Yeah, overall, what we are seeing over the last 1.5 years is that the value where we are present in the value chain as a company is becoming more and more important. So as clearly the profit pool is moving towards more primary sources of value chain within the value chain. For example, within consumer, as you talked about, from FMCG, it is more moving towards people who are producing some commodities or agri commodities and have more strong linkages to backward integration kind of stuff. So clearly what we are seeing is that profit pool or the kind of pricing power is moving a step backwards in the value chain. And this is what is benefiting these kind of companies, which are, for example, some of the companies that you named, some of them have strong backward integration so that inflation will hit them little less compared to people who are ahead of the value chain. For example, some of the FMCG names who are getting hit both by agri commodity price hikes and packaging commodity price hikes that are happening. So clearly where you are present in the value chain, that is becoming more and more important in terms of what kind of pressure you will feel over next few quarters because of inflation. And that is clearly market is also kind of looking at, and that's where things are moving in that direction. So all these companies which are strongly backward integrated and are a bit more protected in terms of inflation, in terms of margins and inflation, are doing better than companies which are like further ahead in terms of value chain. So that's how it is happening right now.
Right. Saurabh, what's your hypothesis on the earnings quality in next 3-4 quarters, given this margin headwinds and your own portfolio? How are you facing margin issues? The companies are facing margin issues. What's your observation? Have you scaled back the numbers?
Yes, clearly for the near term, there will be margin pressures because first round of inflation that happened post-COVID, most of the companies which had pricing power with store brands had passed that on. So since till October of last year, most of these companies had taken price hikes and passed on those first or second rounds of commodity price hike. But because of the geopolitical reason, the kind of spike that we are seeing in energy prices, and now I think even in agri prices, inflation could last a bit more longer compared to energy prices, even after the conflict gets over. We believe near-term numbers could be under pressure for manufacturings and kind of converters who use all these raw materials. So near-term, yes, but what we feel is that when we are looking at companies, we are looking at kind of 1.5-2 years out because equity is a long-term game. So what we are seeing is that good quality companies, if in this type of near-term pricing pressure, if stocks gives us opportunity, we like to get into those names. Primarily because we know these companies have pricing power to pass on these cost increases. It might not have suddenly. So what happens is that input prices might go up very quickly, but pass on will happen with a more staggered approach because the companies know that they don't want to kill the demand. So that thing will also happen. So initial few quarters, yes, there will be pricing pressure, maybe first half of FY23, currently where the situation is in terms of geopolitics and prices. But we believe that there will be pricing power with companies, and we know that happens. And with a lag that will happen, and margins will start to come back by maybe second half of FY23 or maybe the first half of FY24. So this is how we are looking at things. From a portfolio construct perspective, as you asked, we are more still focused on cyclicals. We believe that India is on a cusp of a cyclical recovery, which has already started. This whole kind of inflation pressures and what is happening geopolitically could delay that cyclical recovery maybe a quarter or two, but we are still intact. That cyclical recovery is intact. So we continue to focus on cyclicals. But yes, we have factored those kind of price increases in our numbers, and we are ensuring that we keep these in mind when we do portfolio allocations.
Saurabh, the data shows that in the last fortnight or so, the credit growth has started to improve to almost 9.6%. It was kind of languishing, towing a flat line of 8% odd in full January and February. Do you get a sense that credit growth is eventually coming back? Earlier, it was largely led by retail, but eventually, even corporate demand of credit will come back. And how are you playing that in your portfolios?
Yes, clearly. So we clearly feel that, and whenever we interacted with banks, all of them have suggested that the initial indications that maybe first half or maybe most likely second half of FY23, we'll see corporate kind of demand for loans will come back pretty strongly. There are multiple reasons for that. So if you look at working capital, loan consumption has already started to go up. So clearly means that the demand is there. That is one reason. Second reason is because of inflation, working capital requirement increases because for the same volume, you require 20% more credit to kind of fund that similar volumes if the prices have gone up by 20%. So that is the second leg that is coming up. And as I told you that we are still believing in that cyclical recovery story, and as and when that happens, utilizations will still move up for manufacturing sector and the industry. And then I think 1.5 year down the line, companies will think of starting putting up newer factories, newer capacities, and that credit growth should come up. So from a portfolio positioning perspective, we are clearly focused on larger banks. We believe they are very, very well capitalized. If you look at the tier 1 ratios of some of the larger banks, they are the best in a decade. CD ratios are the lowest. They have provided well for whatever NPS could have happened. So I think they are sweetly positioned for a medium-term outlook. So we are betting on larger banks to play this cycle.
How are you placed on the entire commodity complex? Because, on the one hand, we all know that their reported profits actually would be at record levels. But at the same time, there is a sense that the best of the commodity rally perhaps could be behind it. How are you playing this, improved profitability argument versus realization topping out perhaps?
Yeah, so we have kept that in mind. So in our numbers, we have factored those things. And whenever we feel that markets are factoring in too much good news, we go ahead and trim. So clearly from a positioning perspective, we have not added to a lot of these names. We have actually trimmed quite a few. And we are waiting that how elongated this cycle becomes. So as of now, we feel that some of the names that we trimmed are factoring a lot of good news and we have started to trim them. But yes, sometimes what happens is that we believe that cycle could be like 2 years, 3 years, because it's all about crystal gazing, right? So, but it tends to sometimes elongate. So we'll keep our eyes open if we want to change our longer term assumptions. Maybe we are looking currently at FY24, but maybe 3-6 months we'll get more visibility in terms of what could happen beyond that. So if the things or our assumptions changes, we'll have a relook. But as of now, over the last 6 months, what we have done is we have used this opportunity to trim these names because they have done fantastically well and they've given us very good return. And as you rightly said, it's always good to be a little more contrarian on cyclical names and it's not so easy to get the right exit right at the top. So a bit of contrarian approach in cyclical stock is always better. So that's what we are doing right now.
Sectoral overweights right now, areas where you have been increasing your positions over the last 6 to 8 months?
So clearly, as I said, banks is one of our place where we found valuations plus getting really strong from here on. So bank is one place where we have added to our positions and we continue to add there. Secondly, is a bit of a contrarian call where we have added on to autos wherever we have got opportunities, because what we believe is that with whole cyclical recovery and opening up trades and numbers have not been great for last 3-4 years, valuations are very attractive for these names. So we have been adding a bit of autos. That might sound contrary, but we believe these companies have pricing power to pass on. And if India growth story is there and there is a cyclical recovery, we believe autos should do well. So consumer discretionary and banks is the place where we have added. And some of the material names we have trimmed purely because prices have moved up too fast. And some of the IT names also we trimmed about 3-4 months. So that's how portfolio positioning has been changing over the last 6 months.
We'll let you go on that one. Thanks so much for your time.